This video reviews Itochu Corporation's financial results for the second quarter of fiscal year 2026, covering the period from April to September 2025. Itochu is a major Japanese general trading company, sōgō shōsha. Along with Mitsubishi Corporation and Mitsui & Co., Itochu forms part of Japan's Sandai sōgō shōsha, the three leading general trading companies. Highlights for the first half. In the first half, consolidated net profit reached nearly a record, achieving 56% of the full-year forecast, and operating cash flow hit a record high. Consolidated net profit for the full year remains unchanged at 900 billion yen. Itochu revised its core profit forecast upward, reflecting strong progress in the first half. The dividend forecast was increased to 210 yen per share, marking the 11th consecutive year of dividend increases. The plan for share buybacks was slightly reduced to at least 150 billion yen. A 5-for-1 share split will take effect on January 1, 2026, to make the stock more accessible and broaden the investor base. The net profit progress rate has already reached 56%, showing the first half performance is steady as usual. Summary of business results for the first half of FY2025. Consolidated net profit reached 500.3 billion yen, surpassing 500 billion yen, and showing steady progress toward the full-year forecast of 900 billion yen. This performance was supported by extraordinary gains from asset replacements and strong earnings in the non-resource sector. The progress rate toward the full-year target is 56%, which is ahead of plan. Core profit was 379 billion yen, slightly below from the last year, but if foreign exchange and lower resource price effects are excluded, core profit actually increased year-on-year. The non-resource sector contributed an additional 25 billion yen, offsetting negative effects of forex and resource prices. Core profit improved from 181 billion yen in Q1 to 198 billion yen in Q2, and Itochu aims to accumulate further in the second half. Operating cash flow hit a record high of 609.2 billion yen, demonstrating strong cash generation. Growth investments totaled 392 billion yen, and approved projects for the second half and beyond exceeded 200 billion yen, showing continued accumulation of high-quality investment opportunities. Shareholder returns also progressed steadily. The annual dividend was raised from 200 to 210 yen per share, marking the 11th consecutive year of dividend increases, with an interim dividend of 100 yen and a planned year-end dividend of 110 yen. The ongoing share buyback program amounts to 150 billion yen, of which 98.4 billion yen had been executed by the end of September 2025. Overall, Itochu achieved a record profit with solid non-resource growth, robust cash flows, and consistent shareholder returns. First half business results in more detail, breaking down performance by segment and key factors affecting profits. Consolidated net profit increased by 61.8 billion yen year-on-year to 500.3 billion yen, a 14% rise. About 80% of this profit came from the non-resource sector, showing that Itochu's earnings are now less dependent on resource prices. In terms of profit change factors, the company was negatively impacted by lower resource prices totaling 10.5 billion yen, mainly from iron ore, coal, and crude oil, and foreign exchange losses of 16 billion yen. However, the non-resource segment more than offset these with a positive contribution of 25 billion yen, driven by strong results in areas such as textiles, food, and FamilyMart. By segment, profits rose notably in textiles, food, and the eighth company, which includes FamilyMart. Energy and chemicals also gained slightly, while machinery and metals and minerals declined due to weaker ship-related business and lower metal prices. Extraordinary gains were also a major profit driver. Overall, Itochu achieved strong earnings growth through solid non-resource business performance and one-time gains, despite external headwinds from forex movements and lower resource prices. Core profit by segment and compares it with the same period of the previous year. Core profit decreased slightly overall by 4% to 379 billion yen. However, most non-resource sectors showed solid or improved performance, while the decline was mainly due to resource-related businesses and real estate. In the textile segment, profit rose significantly, mainly because DESCENTE, apparel company, became a consolidated subsidiary and continued strong results from overseas sportswear and OEM-related businesses, such as convenience wear. The machinery segment saw a small drop. Earnings fell in ship-related, automotive, and power generation businesses, but North American power projects and increased ownership in Hitachi construction machinery provided partial support. Metals and minerals declined sharply because of lower iron ore and coal prices, weaker aluminum and uranium transactions, and slower recovery in steel-related markets. Energy and chemicals improved, supported by better profitability in LNG and electricity transactions, as well as increased sales at TAKIRON, chemical products manufacturer, and CIPS, energy and chemical trading company. The food segment grew, driven by stronger performance in provisions-related businesses, Dole and High Life, Canadian Pork Company, along with expanded transactions at Nippon Access and Itochu Shokuhin, food distribution companies. General products and realty fell because of weak pulp prices, higher costs at IFL, and fewer large real estate sales. ICT and financial business increased slightly, with stable performance at CTC, Itochu Techno Solutions Corporation, and Hoken no Madoguchi Group, insurance agency, and improved gains from investment remeasurements. The eighth company segment, which includes FamilyMart, rose due to higher daily sales and business expansion, despite increased costs. In total, the non-resource sector showed solid growth, while declines in metals, minerals, and pulp-related businesses offset part of the gains, resulting in a moderate overall decrease in core profit. Full-year consolidated net profit forecast for FY2025. Itochu maintained its consolidated net profit forecast at 900 billion yen, the same as the initial plan, showing confidence in achieving record-level earnings. However, the core profit forecast range was revised to a more solid and narrower band of 800 to 820 billion yen compared with the original 770 to 850 billion yen. Itochu expects continued steady profit growth, supported by strong performance in existing non-resource businesses and contributions from new investments, despite some negative effects from foreign exchange and lower resource prices. Specifically, the company forecasts around a 35 billion yen negative impact from forex and resource prices, mainly due to the yen's appreciation and lower commodity prices. On the other hand, positive contributions include about 35 billion yen from business turnarounds and profits from investments made in FY2024, such as DESCENTE, TAKIRON, and Kawasaki Motors. Additionally, new investments and organic growth in FY2025 are expected to contribute another 50 to 70 billion yen. Extraordinary gains, including asset sales, will also support total profits. Itochu expects that declines from forex and resources will be more than offset by strong non-resource operations, new investments, and business recoveries, keeping it on track to achieve 900 billion yen in consolidated net profit for the year. Overview of major businesses and turnarounds. DESCENTE showed strong results in the first half. Its business in China continued to perform well thanks to store expansion and increased customer traffic. DESCENTE is also executing PMIs, post-merger integration in Japan, South Korea, and China, such as strengthening directly managed stores and developing dedicated apps, which are expected to drive further growth. CTC, Itochu Techno Solutions Corporation, maintained solid momentum with record-high revenue and profit. Strong demand for security support for manufacturers, cloud services for government agencies, and network construction for local governments supported the full-year forecast. The company's order backlog remains at a very high level, indicating steady business expansion. The North American power business posted strong first-half profit and a solid full-year forecast. Profit increased due to higher electricity sales, driven by strong power demand from AI and data centers, as well as a rebound from maintenance downtime in FY2024. Demand is expected to remain high in the second half, and Itochu also agreed in October 2025 to invest in a U.S. solar power plant to expand its renewable energy portfolio. FamilyMart posted strong first-half profit and is on track to meet its full-year target. It has achieved 48 consecutive months of year-on-year daily sales growth, supported by effective marketing and stronger product appeal. The company continues to enhance stores by adding eat-in spaces and installing container-type facilities outside stores. Digital signage has been installed in about 10,500 stores, expanding its advertising and media business. Regarding turnaround projects, 2 coking coal projects are recovering. In Australia, production slowed early in the year due to geological issues, but has since normalized. In the U.S., restructuring was completed ahead of schedule, and operations have resumed smoothly. For IFL, Itochu Forest Resources and Logistics, the pulp and paper business remains under pressure from high log costs and weak demand, especially in China. However, repairs at its main plant have been completed, and Itochu is implementing cost reductions and sales expansion measures to improve profitability. Overall, DESCENTE, CTC, FamilyMart, and the North American power business, along with progress in resolving issues at IFL and coal projects, showing Itochu's strong execution of both growth and recovery initiatives. New investments made to expand earnings and strengthen its business portfolio. In October 2025, Itochu acquired a 16.35% stake in 7bank for approximately 51.4 billion yen, following a capital and business alliance agreement signed in late September. The company plans to increase its ownership to 20% and make 7bank an equity method affiliate. This partnership aims to strengthen collaboration between 7bank and FamilyMart, which is part of Itochu's The Eighth segment. By installing advanced multifunctional ATMs in FamilyMart stores, the companies will create Japan's largest ATM network, targeting about 28,000 units nationwide. The new ATMs will serve not only as cash machines, but also as platforms for multiple digital and financial services. Itochu expects these investments to generate double-digit returns and sees them as key steps in expanding financial and consumer-related businesses. By combining FamilyMart's nationwide retail network with 7bank's financial infrastructure, Itochu plans to improve customer convenience, expand its financial service ecosystem, and open new growth areas beyond traditional trading operations. In October 2025, Itochu acquired 20% of PHARMA, a leading Japanese generic pharmaceutical group, for about 16.2 billion yen. Through this investment, Itochu aims to enhance PHARMA's corporate value with hands-on management, create synergies with its existing businesses, and expand its presence in the healthcare and consumer-related sectors. PHARMA owns several pharmaceutical brands such as Nichi Eco Pharmaceutical and Kyowa Pharmaceutical Industry, and Itochu plans to support its growth in research, development, and distribution. Itochu's strategic move into financial services and pharmaceuticals, both designed to strengthen its consumer platform and achieve sustainable earnings growth. Itochu is enhancing its hands-on management approach to strengthen group companies, improve efficiency, and support sustainable growth. The company highlights that one of its key strengths is having many medium-sized group companies across a wide range of industries. By directly supporting and managing these companies, Itochu aims to help them grow into future core businesses while maintaining efficient overall group management. In the first half of FY2025, Itochu promoted M&A led by its group companies. For example, Hoken no Madoguchi Group, Japan's leading retail insurance distributor, became a wholly owned subsidiary and executed 4 additional acquisitions of peer companies. This move strengthens its market presence, especially in regions where coverage was limited, such as Kyushu and Western Japan. The company is also introducing AI-based tools to improve customer experience and expand contract numbers. Another example is Itochu Kenzai, a trading company for building materials. It acquired Iwano Busan, a civil engineering materials trading company with a long track record, to expand into non-residential and infrastructure-related markets. Itochu Kenzai will collaborate with Nishimatsu Construction and Oriental Shiraishi to increase its handling volume of civil engineering materials, contributing to infrastructure renewal and disaster prevention. Itochu is also actively promoting asset replacements, selling assets in low-growth areas to reinvest in more profitable ones. Major disposals in FY2025 include CP Pokphand, Hong Kong-based agribusiness company, Provence Huiles, French olive oil producer, and Jamco, Japanese aircraft parts maker. In total, Itochu expects over 300 billion yen in asset exits for the year. Itochu aims to increase long-term profit by strengthening its group companies through M&A, growing medium-sized firms into future leaders, and selling assets to use capital more efficiently. By acquiring highly profitable companies as subsidiaries, Itochu maintains strong profitability. Shareholder return policy for FY2025, emphasizing its long-term commitment to stable and growing returns. Itochu continues to aim for a total payout ratio of around 50%, which exceeds its management policy target of 40% or more for the second consecutive year. This payout ratio includes both dividends and share buybacks. For FY2025, Itochu raised its annual dividend forecast from 200 to 210 yen per share, an increase of 10 yen, based on the number of shares before the planned 5-for-1 share split in January 2026. The interim dividend is 100 yen per share, and the year-end dividend is projected to be 110 yen per share, or 22 yen on a post-split basis. This marks the 11th consecutive year of dividend increases, continuing the company's policy of progressive dividends. In addition to dividends, Itochu plans to carry out share buybacks totaling 150 billion yen or more during the fiscal year. The company notes that this buyback, together with the dividend, will maintain a total payout ratio around 50%, showing a balance between returning profits to shareholders and retaining funds for future growth. Stock price. This chart over the past year shows the stock price in Japanese yen at 9,287 as of November 5th. This chart shows the stock price in US dollars at 115.67 as of November 4. After the earnings announcement, the stock price rose and closed up 3.55% from yesterday's closing price. Current PBR is 2.15 and PER is 14.5. Dividend yield is 2.26%. Compared with historical PBR, PER, and dividend yield, these figures suggest that the current stock price is relatively high. It's a popular Japanese stock, and the price has continued to rise, so it's simply no longer cheap compared to its past levels. However, it's still a good stock to buy and hold for the long term. Conclusion. In the first half, Itochu achieved strong profit and robust cash flow again, supported by solid non-resource businesses. Itochu also continued active investment and portfolio reshaping, acquiring new businesses. The collaboration between FamilyMart and Seven Bank is expected to contribute to future growth. With 11 consecutive years of dividend increases and ongoing share buybacks, Itochu has demonstrated steady execution of both growth and shareholder return strategies.